Here's a shocking fact. The average millionaire has over $1.2 million in debt. That's not a typo. While most people are desperately trying to become debt-free, the wealthy are quietly using massive amounts of debt to build their fortunes. But wait, isn't debt supposed to be dangerous? Isn't that what we've all been taught? Well, there's a reason why the rich keep getting richer, and it has nothing to do with what your financial advisor is telling you. In the next few minutes, I'm going to show you exactly how millionaires view debt differently, and why everything you've been taught about borrowing money might be holding you back. Let me tell you about Sarah, a financial advisor I met last year. She proudly told her clients to avoid all debt and save every penny. The problem? Her average client had a net worth of just $147,000 after 20 years of following her advice. That's barely enough to retire on for 6 months. You see, the entire financial industry has been selling us a dangerous myth. They tell us to fear debt, to pay off our mortgages early, and to keep our money safely in savings accounts earning a pitiful 0.5% interest. Meanwhile, the ultra-wealthy are doing exactly the opposite. Here's what's really happening behind the scenes. Banks aren't just lending institutions, they're wealth extraction machines. When you keep your money in a savings account earning 0.5%, they're turning around and lending that same money to wealthy investors at 4% or even 8%. They're literally using your money to make other people rich. The wealthy understand this game perfectly. That's why they maintain strategic debt positions even with millions in the bank. Take a typical millionaire real estate investor. Instead of paying cash for a $1 million property, they'll use $200,000 as a down payment and finance the rest. Why? Because they can then use the remaining $800,000 to acquire 4 more properties, multiplying their potential returns. This isn't just about real estate. The same principle applies to business loans, portfolio margin accounts, and even carefully structured personal credit. The key isn't avoiding debt. It's understanding how to make debt work for you instead of against you. Now let's shatter another common misconception. Not all debt is created equal. While your parents might have taught you that all debt is dangerous, millionaires understand there are actually 2 distinct types of debt, and knowing the difference is crucial to building wealth. Let's break this down into simple terms. Bad debt depletes your wealth. It's the kind that takes money out of your pocket every single month. Credit card balances, car loans, and personal loans for vacations. These are classic examples of bad debt that keep the middle class trapped in a cycle of payments. But good debt? That's an entirely different animal. Good debt puts money into your pocket. It's debt that buys assets which generate more value than the cost of the debt itself. Think of it like this. If you borrow $100 and that $100 generates $150, you've just created $50 of wealth using someone else's money. Let me show you exactly what this looks like in action. Meet Michael, one of my clients, who transformed his financial future by understanding this principle. Michael had $50,000 saved up and was about to use it to pay down his mortgage, the traditional approach. Instead, we used that $50,000 as down payments on 5 cash-flowing rental properties. Each property now generates $500 in monthly profit after all expenses and mortgage payments. That's $2,500 in monthly cash flow, or $30,000 per year, generated by strategically using good debt. If Michael had followed conventional wisdom and paid down his mortgage, he'd have saved about $2,400 per year in interest. The difference between good debt and bad debt in this case? A staggering $27,600 annually. This is exactly how the wealthy think about leverage, not as a burden to be eliminated, but as a tool to be strategically deployed. Now that we understand good debt versus bad debt, let's dive into the real power of leverage, the mathematical advantage that multiplies wealth creation. I'm about to show you the exact calculations that millionaires use to build their fortunes. Imagine you have $100,000 to invest. Without leverage, you could buy a small rental property that generates a 10% annual return, giving you $10,000 per year. But watch what happens when you apply strategic leverage. With that same $100,000, you could instead make 4 down payments of $25,000 each on 4 different $100,000 properties. Now you control $400,000 in assets, even after paying the mortgage interest. If each property still nets just 7% annually, you're earning $28,000 per year, nearly triple the return on your initial investment. But the wealth multiplication doesn't stop there. While you're earning higher cash flow, those 4 properties are also appreciating in value. At a modest 5% annual appreciation rate, you're gaining $20,000 in equity per year. That's the power of leveraged appreciation working in your favor. I recently worked with David, a tech executive who perfectly exemplifies this strategy in action. 5 years ago, he had $200,000 in savings. Instead of buying one property outright, he used strategic leverage to acquire a portfolio of 8 properties worth $1.6 million. The results? His initial $200,000 has transformed into over $750,000 in equity through a combination of loan paydown, appreciation, and reinvested cash flow. Here's the fascinating part. David's total debt is now over $1.2 million, and he couldn't be happier about it. Because this debt isn't a burden, it's a wealth accelerator that's working for him around the clock. His tenants are paying down his loans while his properties appreciate, creating a wealth-building machine that simply wouldn't be possible without leverage. This is the mathematical advantage that separates the wealthy from everyone else. They understand that strategic leverage isn't just an option, it's a requirement for building serious wealth. Still thinking debt is just for individuals? Let's peek behind the curtain of America's most successful companies. Apple, one of the world's richest corporations, holds over $100 billion in debt. That's right, even with nearly $200 billion in cash, they choose to borrow massive amounts. The reason is brilliant in its simplicity. In 2013, instead of using their overseas cash, which would have been taxed at 35% if brought back to the US, Apple borrowed $17 billion at just 3% interest. This corporate debt blueprint saved them billions in taxes while providing capital for expansion and shareholder returns. Microsoft, Amazon, and Google all follow the same playbook. They understand that strategic debt isn't a weakness, it's a competitive advantage. When these tech giants need to fund new projects, they don't empty their bank accounts. They leverage their strong credit ratings to borrow at incredibly low rates, often below inflation. And here's where it gets really interesting for personal wealth building. The same tax advantages these corporations use are available to strategic investors. When you borrow against appreciating assets instead of selling them, you avoid triggering taxable events. The interest you pay becomes tax-deductible, while your assets continue growing tax-deferred. Consider this. If you sell $100,000 in appreciated stock, you might pay $20,000 or more in capital gains tax. But if you borrow $100,000 against that same stock, you maintain your market position, avoid the tax hit, and can deduct the interest expenses. This is exactly how wealthy individuals mirror corporate debt strategies to maximize their after-tax returns. Smart debt isn't just about leverage, it's about tax-efficient wealth preservation and growth. The ultra-wealthy aren't just using debt to acquire assets. They're using it to create sophisticated tax advantages that compound their wealth exponentially. Understanding when to use debt is just as crucial as knowing how to use it. The greatest fortunes aren't just built on leverage, they're built on perfectly timed leverage. Let me share something most financial advisors won't tell you about market cycles. Every major asset class, real estate, stocks, commodities, moves through predictable expansion and contraction phases. The key to strategic debt timing is positioning yourself at the exact right moment in these cycles. Take the real estate market of 2008. While most people were running scared, savvy investors were loading up on debt to acquire properties at pennies on the dollar. They understood that when blood is in the streets and lending standards are tight, that's precisely when debt becomes most valuable. Fast forward to today's market conditions. We're seeing interest rates at levels that have historically preceded major buying opportunities. While amateur investors are paralyzed by these higher rates, sophisticated wealth builders are actively positioning their credit and capital for the opportunities ahead. The data tells a compelling story. In the last 6 market corrections, investors who secured lending commitments before prices bottomed outperformed those who waited by an average of 64%. Why? Because when assets go on sale, having pre-approved financing already in place lets you move decisively. Right now, we're seeing 3 critical indicators converge: tightening lending standards, increasing market volatility, and rising distressed asset opportunities. This is precisely the environment where strategic debt deployment has historically generated the highest returns. The wealthy don't just use debt, they time it to perfection. They secure their financing before they need it, maintain their credit capacity during market peaks, and deploy capital aggressively when others can't or won't. Let's architect your strategic debt portfolio, the exact structure that creates lasting wealth. I'm going to show you the precise ratios and combinations that maximize returns while minimizing risk. The optimal wealth-building debt portfolio follows what I call the 30-40-30 framework. 30% of your debt should be in appreciating assets like premium real estate. 40% goes into cash-flowing investments. Think commercial properties or business expansion loans. The final 30%? That's your opportunity fund from market dislocations. Here's what this looks like in action. On a $1 million debt portfolio, you'd have $300,000 deployed in high-end residential properties in emerging markets. Another $400,000 would be working in stable, income-producing assets generating monthly cash flow. The remaining $300,000 stays flexible, ready to deploy when exceptional opportunities present themselves. But the real magic happens in the execution. Each debt category needs to be structured with specific terms and conditions. Your appreciation-focused debt should be fixed rate, minimum 30-year terms. Cash flow debt requires interest-only periods to maximize early returns. And your opportunity fund debt needs to be revolving with negotiated pre-approval terms. The implementation follows 3 distinct phases. First, establish your credit capacity across multiple lenders. Never rely on a single source. Second, structure each debt vehicle to match its intended purpose. Finally, maintain strict ratios between your debt categories as your portfolio grows. Let me be crystal clear about something. This isn't about accumulating random debt. It's about building a precision instrument for wealth creation. Each dollar of debt should have a specific purpose, timeline, and exit strategy. Your debt portfolio isn't static. It's a dynamic tool that evolves with market conditions. As interest rates shift, as markets move, your debt allocation needs to flex and adapt. This is how you turn debt from a liability into an asset that works relentlessly in your favor. Now it's time to put this wealth-building system into action. Start by auditing your existing debt. Categorize each liability as either wealth-building or wealth-draining. Next, establish your baseline credit capacity across at least 3 different lenders. Map out your 30-40-30 allocation based on your current financial position. I've created a comprehensive strategic debt blueprint that walks you through each step. This isn't just another financial guide. It's the exact framework I've used to build an 8-figure portfolio using other people's money. Download it now at strategicdebtblueprint.com. Remember, the wealthy aren't afraid of debt. They master it. The opportunity is right in front of you. Take action now and transform your financial future through strategic debt deployment.